So yesterday, a company released its final results for the year, and the share price dropped by 40%. But the company is growing quickly, it's profitable, it's in a hot area. So are the shares oversold? And is there any upside? Let's have a look. So that company was Eneraqua. Catchy name, energy and water, basically, technologies. ETP is ticker, okay? Let's look what they do. So they support new clients and challenges. They're into two areas basically, energy and water. So this is where they put heat pumps in, accurate flow, improves user experience, reduces capex, opex, cuts carbon emissions. These are the clients they've worked with. It's largely councils and some consistent sort of payers there. And this is what they do. This is ground source heat pumps. They put them into these flats, and of course reduce carbon emissions and energy use. And in the water section, around the world, they say there's an increasing pressure on water resources. Our water utility and commercial clients facing increasing regulatory and financial pressures to improve water efficiency and reduce consumption. Now, they've got their own tech here, their own IP, and they say reduce domestic water consumption by up to 26% and cut domestic water and energy bills by up to £90 per annum. And that's some of the clients they work with. All right. So, why the drop? And in fact, let's have a look at the chart here, because it was quite brutal. There we are, 40% down. Okay, we're going from 260 down to 160. Okay, but the drop was because they said, as outlined above, the high inflation seen towards the end of calendar year 2022 impacted our clients' budgets and led them to prioritise or reprioritise, causing individual projects to move between financial years. As a result, a shift of larger, lower margin projects into the current year. The group now expects revenues to be significantly ahead of its earlier expectations, with high single-digit profit before tax margins for full year 24, before reverting to a normal mix of projects and margin in FY25. So it seems it's quite temporary, okay? And this is what the broker says. We upgrade our revenue forecasts, but they've reduced their FY24 adjusted profit before tax forecast by 42% to 7 million. So they're still coming in 7 million, okay? And the order book is expected to support return to more normalised margins. So that's what they say here, okay? Now, if you look at the current trading in order book, a record order book of 130 million, of which 62% is currently anticipated to be delivered FY24. Unwind of working capital with approximately 54% of accrued income at the end of the year is now being converted in cash. And they also say here, improved working capital as the investment in Q4 FY23 unwinds with cash conversions expected to exceed 100% during FY24. Okay, so let's have a look at the spreadsheet, shall we? Okay, share price 162. At that level, the market cap is 53 million. Enterprise value 56. Of course, if that's above that, that means they have more debt than cash. Net asset value 25. Average daily volume around about 146,000. A tenth of that is 14. If you look at size positioning, revenue for the year, and of course this is full year, this is interims, okay? 6 months, this is 12 months, which is what they've released to 31st of January. Revenue for the year, 55 million, 10 million of operating profit. The cash is 3.2, debt is 6.2 million, operating cash flow and free cash flow is negative, and they do explain that it's been quite intensive working capital wise, but that will unwind over the next year or so. So let's look at this, and I always go through growth, value, health, efficiency, momentum and forecasts, okay, because I think that's what's important in the share price. So growth, 52% growth, and of course that's up to 55, so very good top line growth, and operating profit even better, 132% growth. Net profit 110%, and of course we've covered the cash flow, and we've said that's going to unwind, or they said it's going to unwind. Value wise, so growth is largely very good. Value is a good value. Price of sales, it's below 1, so on that level it's very good. PE 6, and so if they're in green generally they're very good. And then of course I put scores in here, and I've got a sort of spreadsheet of scores and companies comparisons. But price to book 2.15, it's not a stretch. EV EBITDA again quite compelling, less than 5. Let's look at health. Okay, they did. The cash did decrease by less than $1 million, and they've got a net debt position at the moment of 2.9 or close to 3. But the operating profit covers debt quite comfortably. Right. Current ratio, can their current assets cover current liabilities? Yes, it can, 2 times, and they're nearly there on the quick ratio. It's a very high bar to achieve. That's where cash, just cash alone, covers current liabilities. Efficiency looks very decent on the margins. 41% gross, operating 18, net 15. Of course, these are expected to come down a little bit and then normalise towards 2025. And return on capital, very good at 33%. Momentum, which is very important, of course, because the share price has dropped off a cliff yesterday, then there's no momentum there. It's dropped out there. It's still, ignore that, because the moving averages take a while to register. In fact, let's just look at the share price here. Look at that. That's the big drop yesterday. If you look up here, 40%. And today, actually, it's bouncing 833, but this is not an uptrend. It may have been oversold now because, of course, you can see there it didn't actually close at the low of the day because the peak went down to what the low. In fact, the low was 150, and it closed at 156, and now we're at pretty much opened at 160. So it opened higher than it closed, which is largely quite a good sign technically, of course. But let's look at some forecasts, okay? And here they are. I pen these in from broker forecasts, and of course also put the margins in and the multiples. And this is what you get basically for 2023. They're saying a 32% share price is going to be 221, which is 32% upside. 2024. 269, 61% upside from where we are now, and in 2025, 322, which is 92% upside. This is based on revenue growth on forecasts of 63% top line for next year, or this current year, 13% 2024, and 10% 2025, and margins of 11% for EBITDA, profit before tax 9, post-tax 8, and the multiples they're based on is 1 times sales, 7 times EBITDA, and 12 times post-tax, and those are the returns you get. Okay, let's look at the broker target. Broker target, we've got Liberum's got 335. That's 168 right now. Of course, that's 100% upside target, so not far at what I've penned in there. In fact, we look at what's happened today. You've got directors buying. They obviously think it's oversold because you've got a couple of directors here buying in aggregate 32,000 shares pretty much, around about 160. They didn't put a price in here, but I put them at 160, so that'll be just over 50 grand's worth of buys yesterday in the market on that dip. So the shareholders or the directors think it's overbold because they're dipping into their pockets, but you have to do your own research. This is not investment advice. I hope this information helped you in some way. Like I said, it's based on growth, value, efficiency, forecasts as well, health. And forecasts, like weather forecasts, they can be less accurate the further they go out. So be careful. Hope that helps.